Welcome, focus learners. I am incredibly excited to share this with you today because we are building the ultimate, fully mechanical playbook for scalping gold. So often trading feels like relying on gut feelings or just guessing where the market is going to go, right? Well, we are throwing that out the window. Based strictly on deep dive source data from institutional trading strategies, we're going to break down 3 highly effective multi-timeframe systems for trading Xauusd. If you've been looking for exact entry triggers, precise exit points, and just a really structured way to handle gold's notorious volatility, you are exactly where you need to be. But first, we really have to address the elephant in the room. Why do 90% of traders fail when they try to scalp gold? I mean, it's a huge number. Well, gold is fast, it's aggressive, and it is extremely unforgiving. We're talking routine swings of 150 to 200 pips in a single day. The underlying problem is that most traders just jump in at completely the wrong time. They end up fighting massive institutional volatility without any safety net, and they just get stopped out by standard market noise. But don't worry, the cure for this chaos is actually built right into the 3 mechanical, multi-timeframe strategies we're about to unpack. Okay, let's dive straight into this. The very first thing we have to fix is when you are trading. If you're out there trying to trade breakouts during the low liquidity Asian session, you are probably just getting chopped up by fakeouts left and right. Contrast that completely with the high liquidity London-New York overlap. When these 2 massive financial hubs are awake at the same time, you get the absolute cleanest price action and the most predictable trends. So your timing is really your very first filter. So here's our game plan for today's explainer. We'll start with the optimal gold trading windows, then we'll walk through strategy 1 on liquidity sweeps, strategy 2 on supply and demand zones, strategy 3 on reversal structures, and we'll wrap it all up with crucial trade risk management. Starting right off with section 1, gold trading windows, and pinpointing that optimal liquidity. Before you even think about looking at a chart, you need to make sure you're in the right environment. The data on this is crystal clear. 1 p.m. to 4 p.m. GMT is the absolute best time to trade gold. This is that magic London-New York overlap. It's the strongest window the entire day because you literally have massive institutional volume pouring in from major exchanges like COMEX and the LBMA. That heavy volume is exactly what prevents those incredibly frustrating false breakouts and actually gives us the clean, structured trends we need for our mechanical setups to work. Let's move into section 2. This is strategy 1. The liquidity sweep, where we capitalize on retail stopouts. I absolutely love this first strategy because it takes advantage of the exact areas where everyday retail traders usually get stopped out. So, what is a liquidity sweep really? It's a very precise sequence of events. First, the price pushes just a bit past a key swing high or low. Basically, it's grabbing all those stop losses sitting right there. Then, instead of continuing on that path, it reverses immediately and usually pretty violently. Finally, it confirms that reversal by causing what we call a break of structure, pushing past the previous opposing high or low. Once you spot this sequence, you know for sure that smart money has stepped into the market. Now, here is exactly how we execute this using multiple timeframes to pinpoint the entry. Step 1, you start with your macro view. Pull up the 30-minute or 15-minute chart. Here, you are just looking for that liquidity grab, the break of structure, and the order block that started the whole move. Step 2 is the zoom in. We drop way down to the micro, 5-minute, or even 1-minute execution view. We're waiting for the price to return to that higher time frame order block, and we want to see a reversal signal. Specifically, we're looking for a violated fair value gap that flips into an inverse fair value gap, or IFVG. Think of it as a sudden pocket of momentum that tells us the trap has officially been set. Which brings us to the actual execution, our strict if-then rules. If that IFVG forms, then you have 2 entry options. You can place a buy limit order at the highest point of that newly formed gap to catch a quick retracement, or, honestly, you can just enter immediately at the open of the next candle. Your stop loss is placed entirely mechanically, just below the most recent swing low, no guessing. And for your take profit, you're targeting the nearest buy-side liquidity or a major key level on your higher time frame. The whole thing is completely systematic.
And that wraps up our deep dive into the foundational mechanics of the gold market. If you follow these rules with discipline, you're already miles ahead of the retail crowd. Thank you so much for watching. If you found value in this breakdown, make sure to smash that like button and subscribe so you don't miss a single update to our playbook. But we're just getting started. In the next video, I'm going to show you how to hunt for high probability supply and demand zones using a strict 2-structure break rule. We'll cover how to time your entries on the 5-minute chart, using bullish breaker blocks, and how to scale into winning positions for maximum profit. You don't want to miss the specific mechanical triggers that turn a simple level into a high consequence trade. I'll see you in the next one. Stay disciplined out there.